Hello and welcome in. My name is Ron Parker. For those of you who don't already know me, I am an active intraday futures trader. I've been trading since 2018 and I've been full-time trading futures for about 2 years now. I have achieved consistency in my trading career and want to be able to share what I've learned with others. Due to the high demand, the number of people, friends and family that have been interested and showing interest in what I do, what my chart looks like, my indicators, all of that stuff. Because of the high demand, I've opened myself up to be able to share with you everything that I know. So this is the first video of many where I teach you from complete beginner to an absolute master on the markets, basically zero to hero, how to start out, what everything is from the absolute basics to and then all the way up to more advanced complicated topics and advanced ways that we can use to sharpen our skills. Okay, so in today's video, we're going to keep things a little more basic. We're going to quickly outline essentially what we're doing today is just teaching people that trading is not a quick get rich kind of thing. This is a skill. It is a business. It is something where you need to perform on a high level and bring a high level of discipline, self-discipline, a growth mindset, and be very gritty, because this is not something you're going to go and pick up within the week and just be slaying it next month and going live and quitting your job. Unfortunately, this is something that can take traders many years, people many years to actually master. So if you want to start that journey, this is a great video for you. Now, I'm sharing my screen right now. You've actually got a live view. Let me make sure it's sharing properly. You've got a live view of TradingView. So right now you're actually seeing a program on my screen that traders use to actually speculate over price in the market. So trading, simply put, is just a bunch of people, all different types of traders, whether they be retail traders like you and me, individual, on up to hedge funds and institutional trading. And so there's a lot of different type of participants in the market, long-term, short-term, and I just aim to clarify a little bit more about why people do that, why this is a profession that people can make money from, and essentially how to actually build a strategy and use it in the market to scalp or swing trade, to take profit from the market and speculate over future price. So what trading really is, it's essentially the buying and selling of a financial market with the goal of profiting from price movement. Okay, so if you imagine really quick, just an example here on Tuesday, this area on the screen I'm circling, the price went down. And so there was people speculating over and taking entries short, where they're actually selling positions in here and covering later in the day and keeping the difference between when they sold and when they bought it back. And yes, you can make money in both directions. I was showing you the opposing direction where you're selling and then you're buying it back. But traders also speculate after buying and selling it at a higher price. So I'll give you an example. Maybe, for example, people were buying it in here and they're selling it higher later in the day. Okay? And traders aim to take a piece of that pie and keep it for themselves. And that's how they can profit from price movement. Okay? There's different types of traders, whether they're long-term, short-term traders. So they could be somebody that's just investing monthly, and maybe they're just stashing money away at the same time every month, and just more like using this as like a retirement savings or an investment portfolio building sort of trading style. There's shorter term traders like me that might be opening and closing trades within the same day. So instead of buying and holding for weeks or months, we might be going in with a microscope, zooming in and capturing little pieces of the market. We're actually trading and closing out trades within, buying and selling them within the same day. Most of the time with these scalpers, we're taking much smaller trades and they're fast moves. So it's almost kind of like a video game to me where traders are using like hotkeys just like you would when playing like a fast-paced video game. I think the ones that come to mind are like RTS style games, or anything you're key binding a lot and actually using like quick decision making to profit off of. So there's scalpers that are taking smaller moves, they're much faster, and they need to calculate the risk to reward in real time. And so you've got a mix of all sorts of different traders in the market, and they're speculating over price, whether they're long-term or short-term as well. Okay. So what markets can people trade? Now, of course, you've heard of stocks, which is speculating over the price of one company or multiple companies, like a basket of stocks. For example, the chart you're seeing right now is the NASDAQ, and this is a representation of the top 100 companies in the US, their stock, and all in one chart. So essentially, it's 100 different companies, and we're speculating over the price of those stocks. And in just a simple chart view, in one chart, we're essentially trading a basket of 100 different companies. There's stocks, options, forex, crypto, and futures. Now, I don't need to go into all the difference and what those are and why, but know that there's so many different charts that people can trade. And what's really cool is everything I aim to teach you in this class, this master class, is to teach you that it's fractal, it's universal. You can learn to trade a strategy in the stock market and then go trade futures with it. You could trade futures and then go learn to trade options. A lot of the concepts that you're going to learn are universal and can be applied to different markets, okay? So that's really cool to know that no matter what type of trader you might end up being, for now, you just need to learn some basics, and it could really build a good foundation for whatever type of trader you end up becoming. That long-term trader that's investing, or shorter-term speculator like an intraday day trader like myself. So you'll be able to develop over time and participate in different ways. Now in futures, which I trade, we trade in contracts. So if I were to give you an example, we might use this as an example here, where we sold a contract. So it might be like at this level, we might have done minus one contract. And we could have covered that position later in the day by going and adding one contract back. So we sold a contract, and then we came and bought a contract, and we keep the difference. And it's the same but opposite when you're buying. Maybe we can go to an area of strong buying and show you that people might have bought in here +1 and then sold it later that day for -1. And so in futures, it's really simple because they're just measured in contracts. And contracts can really truly be just like a multiplier. The more contracts, the more you're multiplying your winnings and you're losing your risk. Your risk increases and your reward increases as you go with more contracts. So something like 3 contracts would be 3 times the leverage of a single contract. It's exactly 3 times. So there's no limit to sizing truly. You can size up as big as your account can handle. And in time, we aim to gain consistency with a strategy and slowly but surely increase our risk and reward by increasing the amount of contracts that we're trading. Okay. Now, let's talk more about what makes up a chart. So right now you're seeing things on the screen. You've got these green little blocks, rectangular looking blocks. You've got some yellow lines, and you're probably wondering what all this stuff is. Okay, let me zoom in a little bit and give you an example. I'm just going to super zoom in on one of these 30-minute candles and break it down for you. You've got the open, which is, whoa, sorry, my mouse messed up. We've got the open, which is this level right here. And we've got the close, which is right here. And the candles are made up like that and comprised of opening and closing, but they also have the distance that they traveled or areas they traveled where they may not have actually opened or closed at, and that can be represented as a wick. So you see these lines. Let me draw an arrow so you can kind of see. Here we go. You see these wicks? These wicks are telling me that price explored up to here and down to here, but it really opened and closed at nearly the same price. The body of the candle is really tiny, where the body of this candle next to it is really big. So this one actually held that price increase. And it actually, the price rose from this point up to this point within that 30 minutes. Now, if you zoom in even further, you might see that on a small time frame, it's going up and down to compromise this, to make up that 30-minute candle. But just know that the candles represent where price discovery happened, where price, the range of price movement, and the actual opening and closing, which is like the acceptance of price action. Okay? So really simply put, if we see these candles, you're going to see things like the price started here and sold down to this level. And then if we look at some other ones, the price opened right here on this candle and closed right here, increased. So I color them, the candles, based on their, whether they're above or below my EMA, this yellow line. And that just gives me a really quick visual of which side of the trade we should be on as far as bias. For me, when the candles are black, that tells me that I want to be going short and going minus and essentially shorting the chart. And then when the candles are green, I have a preference of buying. Okay, so it's just giving me a really quick visual. The gray ones for me are also when they're too close to the EMA, which is like candles I shouldn't be paying too much attention to. They're flat, they're sideways, they're no good. And you want to see a clear trend. For my strategy, I like to see a clear trend. And a trend can be defined in different ways, but it's basically a clear directional move, clear directional bias. I look at a 5-day trend. So I'm using the average of prices over the last 5 days to determine whether price has been going up for this last 5 days or down. If they've been going up, you can see that visually with a positive sloped line like this EMA. The EMA, you might be wondering, well, what does that stand for? That's a exponential moving average. And simply put, this yellow line just smooths out what the price is already doing. It's the same thing as the candles, but with less detail and more of a smoother look. So as you can tell, like price, clearly these candles were going up and up. And this yellow line just helps me visualize that the price was clearly in an upward direction and that I should prefer to be buying when we're above this level and we have green candles. Okay? So, EMA, exponential moving average, that's this yellow line. We've got candles on the screen, which represent where the price moved to, where price was accepted and denied. The wicks, or remember, the little lines above and below the candles are just where price discovery happened, where price moved to, but maybe didn't hold for too long. This is a good example where price reached way up there to the top of this wick, but it didn't hold. It got rejected. So it just looks like price went up to that level and came right back down. It wasn't accepted. So we've got wicks. We've got the body of the candle, which is kind of like the thicker part of the candle themselves. And now we can start to kind of understand what's happening on the chart based on the size and shape of the candles, what the wicks look like, what our EMA looks like. And we also have things on our screen, other indicators, which EMA is an indicator. We've got other indicators like volume, and the volume are the colored bars at the bottom of the screen. Now, of course, I'm not going to go into too much detail on any of these one indicators yet. We're going to keep it simple, but traders use these indicators to help them decide whether they should be taking a trade or not. Now, the volume specifically, I have mine colored by relative volume. So the purple bars mean that there was extra volume way above the average. The orange bars are high above the average as well, but the green and the blue ones are like below average, low volume. And you can see the amount of volume by the size of those volume bars too. Like if the volume bars are really tall versus the one before it, then volume increased on the candle, on this candle versus the last one, for example. And it should be kind of viewed vertically. I'll show you here. So this big green candle on the screen here, let me circle it, can be seen in the volume at the bottom where that white line's touching. This big volume bar, it's because there was a lot of participation. A lot of participation within that 30-minute candle. Okay? So we've learned a little bit about the EMA, what that is, the yellow line representing a smoothed out version of the price. We've learned about candles briefly and what they how they're comprised and made up, and volume, and how maybe a trader could use a combination of things to help speculate over price now and in the future. Okay, so we've covered quite a bit. I think there's some other things that we can talk about is in your trading platforms, you can look at candles of different value, like a daily candle, where each candle is comprised of an entire day of price action. So each of these candles on the screen is one day. And if we zoom into something like a 30-minute chart, each of these candles is 30 minutes. And on down, we can go further in, like viewing like with a microscope, or zooming in. You can view the day into minutes. And so each of these candles are 2 minutes at a time. So we got this like top-down perspective where we can look really zoomed out. We can zoom in some more. And then we can zoom in a lot. And essentially using these multiple time frames can give us an advantage or a better context of what's going on in the market today and what's likely to happen next based on what we're seeing. So VWAP. We haven't talked about VWAP. I'm going to cover that one. This is the purple line on my screen. VWAP is volume weighted average price. This is another indicator, just like EMA and volume, that we use to help us determine if we should be taking trades or not and what direction to take them. Now, simply put, when price is below VWAP, like in here, we're looking to go short or sell. And then if price is above VWAP, we're looking to buy. Okay? Now, because the VWAP, the volume weighted average price, is on our screen, it's really there to help us visually see with a really quick glance who's in control. If price is below the VWAP, sellers are clearly in control. It's only true to a certain point. Like you can see, sellers are truly in control until down here. And then all of a sudden you've got the switch where VWAP's not being respected anymore. We're now coming back to the average. What's the average? VWAP is the average, the purple line. So you'll see that these same moves happen all the time where we get expansion away from the average, or VWAP, and trades back to the average, volume weighted average price, the VWAP. Okay? So that's the purple line on my screen. You'll learn all about it again in future videos. If you want to like and subscribe, let me know what you're interested in. But we will definitely be talking more about each of these things in more detail as we dive into strategy and advanced lessons as well. Okay? One of the most important beginner lessons, though, is risk. So as a trader, our ability to profit comes from having good risk control. So we've got these brackets we can use that help us understand whether we are buying or selling. With these brackets, they kind of help us get a visual. The green area is our profits, and the red area is our stop loss, like our risk. So it kind of goes like this, where the white line in the middle of these boxes is our entry. The red line up here at the top of that is where we would get out of the trade, the stop loss. And then the green area is our take profit. Okay? And then we can structure it like this is a 1-to-1 where the top part is equal to the bottom part. It's equal portions. If we lost 1 here, it's equal to plus 1 here. It's the same. Oh, that's a 2. It's equal, the top and the bottom, risk and reward. Okay? But if I were to change that, we could cut the risk in half, and suddenly we're now at a 2-to-1, where we might be risking something like 1 unit to make 2 units. Okay? So we refer to that as risk versus reward, and it's used to drive all of the trades we make. All of the trades we make are going to be based around our risk to reward, because if we mathematically put it in our favor, where we're making more when we're profitable and then we're losing less when we're losing, we can get an advantage in multiples of risk by structuring the trade properly. So we'll learn more about that and how we actually structure our trades in the future, but know that risk management is super important. Not only do we control the risk in the trade versus reward, but we also control the risk on how much we're bringing to the day. A lot of traders bring a daily budget. So let's say, for example, you brought $500 today to the market. Traders will limit themselves to a certain amount of loss limit that they predetermine before the day even starts. Did you get enough sleep last night? Yada yada. Is the market in a good position to be putting risk on? And you might determine your risk for today based on your account size and your risk parameters. So know that traders, successful traders, they always use a stop loss. They use a daily stop loss, a daily limit that they get out line in the sand that says if they're wrong, if they're not doing well, that they're going to be able to get out with a limited amount of capital lost. Okay? So they bring a daily loss limit and they structure their trades in multiples of risk using brackets. Okay? 2R, 3R, whatever their strategy might give them. They work in brackets. They work in risk. Everything's about risk in trading. Risk is so important. The first goal is not to make money. The first goal is to survive long enough to learn. Okay? So, a roadmap for a new trader. Like if you're just starting out and this is the very first thing you're doing, what does this look like? Well, you're going to learn about more of the market basics, more of the chart basics, learning risk management. You're going to learn one strategy to start with. You need to master one specific strategy at a time. You'll practice in simulation, a fake, not live environment, or even where your trades aren't actually going through and participating in the market, so you can practice on paper and see and make sure you're actually profitable on paper and show consistency before you start risking your own capital. So you'll practice in simulation, you'll take practice trades, which we can do live in the future. I'll show you great examples of replay trades you'll want to take. And let's go to a different day just to show. And then only then, after you've proven consistency and you've spent time and effort into actually practicing and refining and developing your strategy, and you on paper you're showing a true amount of consistency for a good period of time, and only then can we consider going live. Okay? So of course, I'm going to be the person to help you with that. We're going to be diving into so much more than what we covered today in much greater detail in the future. But step by step, we're going to start from the basics, 0 to hero. If you're completely new, I hope some of this helped you just kind of get an idea of what a trader might be doing, what they're looking at on the chart, what all these squiggly lines mean and little rectangular bars, all these colored different things on the screen. To help you better understand what we're looking at, we're going to build on that. You're going to learn so much more about each of these indicators I use and I recommend. So much more about what all these colors mean, how to determine directional bias, how to structure a good trade. We'll talk about psychology, all sorts of things, multiple strategies. Okay? So let me know in the comments below Whether you have anything specific you'd like to ask me, I'm an open book, happy to help. But if you don't, feel free to subscribe and check out the next video. We're going to be talking about more of this stuff in detail. This is a first part to a video series where I will be recording live and actually sharing a lot of this stuff with you guys in time through a video series. I've had so many people ask me about how to trade and how I do what I do, and I feel like it's time to actually make it a little bit more structured, where I don't have to repeat the same things to the same person, people over and over, that I can create video content and share it with new traders, share it with traders that are developing, or even successful traders looking to gain more value and edge, that they can come and join in, they can watch videos, view content that's been recorded, and it keeps me from having to repeat myself as much. So for those of you that joined live and watched this video, thank you. I appreciate you and for hanging out and tagging along. For anybody watching this in recording, remember to check back with me. There will be more content in the near future covering more and more topics to teach you how to trade, going from zero to hero. So if you're interested, stick around. There's definitely more that you're going to find out in the future about how we can speculate over markets and potentially walk away with a profit. So thanks for stopping in. I hope you guys have a great one. See you next time.